Hey guys, it's Jelly. So there seems to be a little bit of a mystery when it comes, a mystery or confusion or something about whether or not you're required to file. And I can see that especially if you're a young adult. Maybe you're in school, you're fresh out of your parents' home, and you're not sure if you're going to file. You think they're claiming you so you don't have to file or whatever it is. I kind of just wanted to go over that and just make sure everyone knows whether or not you're required to file. Because one thing that happens if you are required to file and you don't, you can accrue a penalty. If you are required to file and you don't, and you would have owed taxes, you'll accrue interest on whatever from whatever deadline that was supposed to be. So April 15 every year. If you don't pay by then, you're going to accrue interest on that. So I kind of just wanted to go over what those tests look like. So there's pretty much four things. So there's your gross income, there's your filing status, there's your age, and whether or not you're dependent, and then I'll also add whether or not you're self-employed dependent, and then if you're self-employed. So I would say initially the first thing I would look at is if you're under the age of 65. I'm going to assume that if you're watching this video, you're under the age of 65, so the rest of the video will be based off of that. But that just changes the numbers a little bit. If you're over the age of 65, you have a little bit of a different requirement. You have a little bit more wiggle room. So let's say you're under the age of 65. The next thing that you're going to be looking at is your filing status. So I went over on one of my previous videos filing statuses and standard deductions and what those are. So let's say if you're single, you have what you call a standard deduction of $12,200. If you're married filing jointly, is $24,400, or head of household $18,350. So all of those, whatever, those are what we call your gross income tests as far as whether or not you're required to file. So let's say you're single, you're going to end up filing single. That means anything you cannot, if you make any more than your standard deduction. So if you're single, that's $12,200. You are required to file by the IRS. If you're married filing separately, if you make any more than $5, you are required to file by the IRS. So that's the next test. So you're under age 65. It changes those standard deductions a little bit. So based off your filing status, you figure out what that standard deduction is, and that's your gross income test. So your gross income cannot exceed that amount and you not file, or you'll be liable to be penalized. And if you ended up owing, you'll be liable to not only accrue a penalty, but also interest. And then the next thing to think about is whether or not you're a dependent. So I know for the people who are fresh in college, or you're fresh out on your own as a young adult or whatever, maybe even if you're below 18 or below 19, you might be thinking that you may not have to file or you're getting claimed as a dependent, but that's not always the case. So there's pretty much three things to look at when you're a dependent for someone. So one is your unearned income. So that's your ordinary dividends, your taxable interest, all that kind of jazz that can't exceed $1,100. That's a little bit different if you're a dependent for someone and you're also married. But I'm just going to base this off of if you're single. If you're earned, if you're a dependent for someone else, you can't earn more than $4,200 without filing. So that means if you earn $4,200 in one, or if you're earning in that window, you're required to file, right? So your earned income can't exceed $4,200 without you being required to file. And then there's the gross income test, which is just a little bit of math. So it's either the greater of $1,100 or your earned income plus like $350 or something like that. And if your income exceeds those numbers, your gross income exceeds those numbers, then you're required to file. So the gross income test. And then there's also if you're self-employed. So if you're self-employed at all and you make more than $400 in self-employment, so that's 1099 people as well, then you are required to file. That's mostly because self-employed people, unless you make estimated tax payments, you're more than likely not getting federal tax withholding. So that means regardless of what you're making, they need to know what you're making, and you need to pay taxes on that. Because for these other people, if you're a W-2, they're withholding, they might come out even. But if you're self-employed, you only pay taxes when you actually actively go and pay taxes or make estimated tax payments. So yeah, these are pretty much the general idea of whether or not you're required to file. So just remember, it's based off your standard deduction. So if you're single, if you're making more than $12,200 in that tax year, you have to file. If you're married filing jointly and y'all both make more together, more than $24,400, you have to file. Head household $18,350. And from there, and if you're a dependent, there's also those other tests of unearned income and earned income generally over $4,200 earned income, you have to file. And there's also some exceptions about special tax payments that you might have to owe and stuff like that. And then in general, like, it's not as scary as not filing. Why? Because a lot of times, if you're in these situations, especially if you're towing the lines of the income, you're more than likely going to qualify for a tax credit or something. Yeah, you're more likely going to qualify for a tax credit depending on what your income is. And so a lot of times you can find out that you were probably missing out on a refund, even if you didn't pay more taxes than you owed. They're what we call refundable tax credits that maybe you can get a little bit more money in your pocket. Like we always talk about the American Opportunity Tax Credit, where you could possibly get $1,000 to you if your tax liability is zero. So that's just a little bit of reason why you should file. Or let's say you had tax withholding and you were under that $12,000. Let's say if you're a single person and you earned less than $12,200, but you did earn and you did have taxes withheld from your income throughout the year. You're entitled to a refund for that money because that standard deduction reduces your taxable income. If you only make $12,200 and you pay taxes throughout the year, your taxable income is going to be zero if you're single. So there's just a reason I think most people should try to file or see or just get a preparer who can run those numbers for you and see what that looks like. They are spending their time, but for a lot of people, especially me, I don't have a commitment until after you sign and file. So yeah, make sure that you don't have to file, and then if you do, or even if you don't have to file, make sure that it's not if it's in your benefit to file, make sure that you do and get that free money. So yeah, that's just a little bit of education for you. I'm a tax professional. If you want to work with somebody who's going to be invested in not only your tax situation and making sure that you reduce your tax liability and plan for the following year, but also your financial goals in general, definitely contact me so we can get your tax return done and we can start you on your way to your financial goals with some help. But yeah, I hope you learned something, and I'll talk to you next time.